what a new intro. We told you guys we're gonna get some new makeup on the upcoming episode. Well, that was it. Welcome to episode number 7 of Futurum Equities podcast. You got myself, Shy Valor, aka Stock Savvy Shy. We got Daniel Newman, aka Danny Dimes, and then we also got apparently a bear market that starts today. That if you read all the headlines, they're like, "Oh, it's a bear market, August pain, etc." So we're gonna delve into that big time, and I want to pass to you, Daniel, first on how you're reacting to a morning like today, because I know you and I are experiencing the short-term pain of the market pullback.
Oh, it's very inconsequential pain so far. Now let's be candid. Like if a couple percent pullback and then it perpetrates for days in a row, we could see a real slide. But it seems like everything here is all about get it done fast. Doesn't matter if it was the pullback on tariff news, pullback on jobs news. If it was the pullback on the SoFi shelf, they get through this crap fast and let's get back to growth. Are we entering a pullback? I mean, look, everybody's got to be kind of realistic, Shy, about the fact that like we've had this incredible run since April, like a 3-4%, pullback on maybe the S&P, maybe 7-8-9% on growth. And it might be bigger on some names, like, some of the ones you love that have no revenue and no profits that, like those companies may see 20%, but you got to remember they've gone up like 200. So like that's part of the game. And by the way, if you really believe that's the time to, you get longer, right? You wait for those kinds of moments to get a little bit longer. So, by the way, Shy, I mean, not only was the intro awesome, but we should probably let everyone know, like this thing, like if you're watching this now and you're like, hey, I got a jet, but I want to catch it later. We're on all the pod channels now, the Futurum Equities podcast, right? On Apple, on Spotify, wherever you get your podcasts, check out Futurum Equities podcast and hit that subscribe button and give us some reviews. We need to get this thing moving in the algorithm, right? We need to get people hearing what we're doing because, we're messing shit up. Oh, wait.
Yeah.
Now we got the parental advisory. Dang it.
Now we're always going to keep it raw, but yeah, we're everywhere. We heard your feedback initially. We've had incredible momentum the first 2 months, first 6 weeks actually of this, and we wanted to put it on every channel possible. But on my market thoughts of today's bloody day,
let's hear it.
I mean, listen, I'm down 2% right now on the day. That's minimal on what the year it's been like. And I know it's funny because the market psychology is always it rhymes. People are so accustomed to up to the right that they kind of forget the pain of a really bloody red day. And I think that it's really important to know that we have not topped. I think that the past week alone shows you how early we are in on this AI trade. This is called a trade, but it's going to be in multiple years, maybe a decade long, but it's very long runway. And you're seeing these massive earning beats. And you're seeing that inflection quarter, I think, from like that Microsoft's, the Metas, even Amazon. That was an incredible EPS beat on the retail side of their business. We'll get into that later, but I think that we have not topped. I just think that we need to maybe pull back a little to get some of the overzealous traders who participate in the summer to maybe take it back a bit, where the daily RSI was overextended on all major indices, 70 plus. Yeah, go on.
Yeah, no, I was gonna say it's greedy, it's frothy. And we actually have talked about this as much as you and I are bulls. Like we are emphatically bullish, and even when we don't like something, our tactic isn't to short it. Our tactic is to just avoid it, right? We just stay away from names we don't like. Like you stay away from names you don't like Hims, you stay away from Robinhood, you stay away from all the names. I'm joking.
All the winners.
You don't like. But here's another thing that I think is really important. I tweeted something about this yesterday, and it got a lot of engagement. And that basically, this is not the internet boom. AI and the internet boom, that parallel, it's stupid, cut it out, it's nonsensical, it does not make any sense at all. You're talking about, back then we had pets.com and we had these internet companies that had tons of backing from venture, but they had no real money, no real profit, no real business, and it exploded to unreasonable valuations, not to mention the timeline's different. Now, if you look at the AI boom, this is like some of the most robust, strong operating leverage, balance sheet rich, cash intent, cash laden companies. You've got, NVIDIA, billions and billions on the books, including trillions in market cap, endless investors willing to buy the dip, right? They will buy and buy and buy and support this company. You've got Microsoft, you've got Google, you've got Amazon. These companies are so robust that yes, but it also made me think of something else that is really important. In this sort of run up, not all companies are equal, meaning that, like when you're investing right now, like, look, there might be a pullback in Microsoft. I mean, it's run an incredible race. If I'm an investor, I'm sleeping like a baby, even if it pulls back 10%, to know there's a whole nother leg up, right? Now, if you're super long on Figma, and let's just talk about stupid, okay? If you're super long on that, you do have to look like, couldn't Cursor do this? Like, couldn't Cursor and OpenAI like build something to pretty quickly replace this? By the way, I had one CEO tell me that, you just don't want to be parked on SAS Avenue right now because SAS is a bad neighborhood. Very funny quote. But the bottom line is Figma's a SaaS company. And a lot of what they do, and by the way, Figma at 20 billion might have been a great buy. At 25, it may have been a fair and appropriate value. Running to 60 in a day, like
ridiculous.
By the way, just one other thing, because I know I'm dragging on here, but like the short thesis on something like Figma is really good here. Having said that, the market's ability to keep an undervalued asset overpriced for a long period of time tends to last a lot longer than most short sellers' cash. Wouldn't short it. I'm not saying this is, but like, all the point is like, if you stay with your thesis in the AI in the AI trade, and you buy great companies that have great moats like Meta and Microsoft and NVIDIA, I don't care. I mean, maybe they're a little bit overvalued, but over time they will keep going up.
I mean, before we get to the SaaS conversation, I think I want to talk about Microsoft because SaaS Avenue. Microsoft, what the holy moly, Azure. I think if people were questioning if there's going to be an ROI on AI spend, I don't think you have to question anymore. Just look at Azure numbers. Meta too. But like before we get into Meta, like Azure added $4 billion in cloud revenue alone this past quarter, 4.2 or 4.3. That was 2x the previous record for cloud on any kind of quarter. This is a business that's inflecting. And I think that, yes, we don't really know what's kind of being put into that Azure bucket. It's a lot of wonky deals. But I think it was really important that the reacceleration they saw a quarter ago, which was 35%, it's reaccelerating again right now at 39%. And I think that the Google Cloud deal with OpenAI wasn't ideal, and people got a little squeamish on what Azure is going to look like. But Copilot usage is clearly exploding, and I think that the GitHub Copilot also has gone up like 4x, and I think the Copilot for Work is now becoming an actual platform. I think previously it was like more of a demo, and I think it's like touching 90% of the Fortune 500 companies. So I think they're kind of positioned perfectly in the enterprise space. Valuation is obviously going to be such a but if you want to invest on like who's actually monetizing AI right now, I have to put Microsoft as the top of the funnel of like chef's kiss on this type of report. But I want to pass it on what your thoughts on Meta was, because Meta was the biggest performer post earnings among like I think this week's like group of tech earnings.
Can I just slide a thought in on Azure first?
Yeah.
Satya Nadella is the best non-founder CEO on the planet, bar none. And I like Lisa Su a lot. What he has done in we talk about being like a performing CEO, a showman. You like that term, right? Mm-hmm. And I actually think in this era, the showmanship of a CEO is going to become increasingly important, especially if you're not crushing numbers. But like what Satya has done, and he's not a showman in the Vlad or the Palantir Carp kind of way, but he's a showman in the sense of like his moves are so good. What he did with OpenAI, the way he encased them in the Microsoft bubble. Remember, this company has no real chip or infrastructure to speak of. They've not been able to produce at scale any sort of AI chip. They haven't produced a model, not a frontier model. Like, so while Google has Gemini and Amazon has Titan and Amazon has Nova and they have Inferentia and Trainium and of course CPU, Microsoft is doing the fastest growth, barring Oracle, which Oracle has a law of large numbers challenge. It's still going to catch up to them now that they're getting bigger. But like it is incredible. And now you actually hear that maybe they're going to get OpenAI wrapped up long term? So this is really important for investors, Shai. Is they're going to get OpenAI wrapped up long term and then maybe set the bird free, but they're going to get control in this process. So, right now, OpenAI hasn't been able to do the public benefactor, haven't been able to go public. They've been struggling to be able to get the capital that they've raised because of the Microsoft womb they've been stuck in. So Satya took $10 billion, turned it into roughly 160 in his investment. And now he's probably going to turn it into 2 to 4 times more by letting the bird free, by letting OpenAI fly. But he's going to, all kind of the turnover at AGI that we're heard about, like they're going to get, like they only have access up to AGI. I bet you he's going to do something to change the term of that deal to make sure that basically Microsoft keeps the exclusivity on OpenAI for as long as possible. Who cares what infrastructure it's running on? He's going to control that, and he's going to completely fix the fact that they didn't build their own model. And that was a super move, and it deserves some acclaim. Okay.
No, yeah, I agree. Yes, let's get into Meta. Yeah.
Yeah. Sorry about that. You know me. I can never go quick. Best use of it, best company. So Bloomberg, actually, they put me on the spot. Did you see that segment? Where I went.
I did. That's why I want to bring it to Meta. Great segment.
And she made me choose. And by the way, that was like, oh my God. I can't even, I'm trying to think of a good parallel.
Sophie's choice on AI, enterprise
it's like
AI.
Choosing between tacos and pizza, just two things I loved and never knowing which one I actually want. It was perfect. I picked Meta. Okay. And let me say why, because when you talk about the application of AI to make money, this is the company that, by the way, no one will ever need to pay for their AI. They have 1 billion users on Meta AI already. And now what they've just done is they built the New York Yankees of a research team. Now, again, do the Yankees win every year? No. But have they bought more world championships than any other team? So Zuck's spending billions to make trillions. He's literally spending billions of dollars to make trillions of market cap. And I actually think while there's a small possibility he can't get the team and the talent to work, it sure looks like he's got the Yankees, he's got Manchester City. You pick your sport of where a team bought their way to the title, and Zuck has totally bought his way to the title, and he's delivering incredible profitability on AI right now.
Well, I think it's also he knows the opportunity that's in front of him. Nearly half the world logs into a Meta app every single day. So that alone provides them such a massive lever to pull if he can monetize AI in a optimal way. And in order to do that, you need the big AI brains under the go on the ship to figure that out, because the super intelligence race is going to be explosive. It's going to be highly competitive. They're going to be sticking their elbows out between competition, who's going to get there first. And Zuckerberg isn't investing billions of dollars in data centers and LLMs because he hopes it'll pay off. He's doing it because he's seeing early signs of how explosive monetization has been from AI. Like the fact that Meta grew top line, I think it was like 22% revenue, while the profit grew 40%, while they dropped $70 billion in CapEx, is mind-boggling. It really is. And I think that they are trying, like, making this narrative change of monetizing attention to monetizing intelligence. And you and I agree on this. AI is going to be an indefinite demand curve. It's not going to be like a previous super cycle where it's a lump sum all of a sudden and then they turn the switch off and then they're going to move on to the next and latest greatest. It's going to be indefinite. So who's better positioned on the consumer app space than Meta when 50% of the world goes into their app? So I think that right now they're a $2 trillion company. I think earnings multiple might look a little pricey right now, but you have to keep in mind the CapEx spend that they're doing right now. It's going to eventually normalize, but guess what's not going to normalize? The monetization of AI. And that's why it's like, wow, Zuckerberg is he's playing chess and everyone's just complaining about the checkers move. And I think it's one of those names where if you bought under $100 3 years ago due to the Reality Labs headwind of CapEx, kudos, because I think that's an entry point you're never going to sell.
I know a few people that dumped at the bottom in the middle of the Reality Labs thing. Oh my God, it's brutal. And by the way, large positions, and at the time it actually was like, what is he doing? But by the one last thing on that though, Shai, is that whole Reality Labs thing becomes a really big boondoggle in the AI era. It was one of those cases of
it was too early.
early, but not wrong, but
Yeah.
actually wrong because you're too early. You know, we like to talk about that, but like,
yeah.
but a billion users, Shy, a billion people on Meta AI, a billion people just feeding their data day in and day out to that company. I shared something on social. I was all revved up by someone, you know, shit posting me on Twitter. I don't normally care. Like, you don't read the replies because if you did, you would probably not sleep at night because I've seen some of the ones in your streams. But like, you know, but anyways, I was sharing something. Someone was kind of saying like, nobody. I don't pay. The comment was, I don't pay for AI. This is a bubble. Like, I don't pay. I'll never pay. It's like, did anyone pay for search? No, nobody paid for search. Did anyone pay for social? Not really. Nobody's paid. Like, all we have now is we have an exponential version of search and social where AI can now actually do all these things at a scale that is unfathomable to generate revenue. And it's going to be better. It's going to be faster. It's going to be more precise. God, people are getting this so wrong. You're so wrong. Like, if you don't, you know, I'm sorry. You're just wrong. You're
All right. So
okay.
going off of wrong takes, we got to go off of SoFi's earnings this week and also SoFi's secondary that people were just like so wrong on the following day, and how I want to speak. I'll let you speak and I'll follow up on it.
Yeah, find this tweet. Keep talking for a second because I want to find my tweet where I actually saw what was happening. What's your take on it, though?
My take on SoFi is wow, like just absolutely wow. If you talk about the membership growth, like that exploded. It felt like a earnings report where everything is aligning now for them. I think Noto has constantly invested in the company operationally. He's not a showman like we talked about, where Satya is a showman in a different way than Carp, different way of Vlad. Matthew Prince, Cloudflare. We'll get into Cloudflare. He's an absolute showman. Bill McDermott from ServiceNow, he's a showman. When we say showman, it's not a bad rep. It's because in this environment and post AI new digital economy, all these products are going to look the same. It's going to be tomato. It's going to be up to the CEO to be able to communicate what their moat is and why they're different and why they're not going to survive but thrive in new digital economy. In order to do that, you need the right CEO to lead that ship. So Noto is an operational ninja. He's been doing this for years. He doesn't care about communicating the message because he thinks execution will speak for itself. I think this report proved that. Everything was a clean beat. Maybe guidance was a little lighter, but that is the Noto way. Under promise, over deliver. The one caveat I had was within one day, they announced that $1.5 billion secondary. For me, poor corporate governance, because why not just do it at the same time as the earnings reports? And I think that typically that is the case. They have a major catalytic event, announce an offering at the same time, and do it right there with intentions all there. So it's kind of weird that within 12 hours, but also think about the long term. Noto is probably making a crypto play. And when the stock is ran up the way it has, and he just had probably one of the best earnings reports in years from SoFi, he's confident enough that will speak for itself to provide a high floor on any kind of secondary offering. Guess what? He was freaking right. That $20 or $21 is now the new floor on any kind of pullback. Even today, down what, 6-7%? What was the floor? $21. But anyway, you're the big shareholder.
Yeah, well, pull that tweet up. Can we pull that up and share it? But I put it in the chat. The bottom line is your assessment of the earnings was spot on. I'm not going to lie to everybody because I'm kind of a man's man. I don't wear an engagement. I didn't wear an engagement ring during my engagement to my wife. I waited till I got married. I actually cried when I saw that earnings report. And like, you got to understand when you have the position and you've taken the kind of risk and spent 4 years suffering. When I saw that report for the first time, I said, this is the end. I'm not saying it won't go back to 18 or retest some sort of moderate, pullback. That could entirely happen. But like, he literally shut the door on the idea that this thing's going to go back to $5 at some point. If it does, if this stock goes back to $5, the entire economy has collapsed. Like, the world is in an ending state. He reset the floor, blew it out of the park, by the way, and we have all these catalysts that could actually make this stock a good stock in a pullback. You've got rates getting lowered, good for SoFi, right? You've got the student loan ending, good for SoFi. A crypto play, good for SoFi. Expanding options, good for SoFi. They're a bank. They're doing the loan platforms that are super high margin, and they got the tech platform where they're actually. So look at my tweet. I basically said after the offering, I put this out. This was pretty immediately after. I said retail is being shaken out, while institutions were gobbling up the shares. Okay, and I basically said that the price action and the target increases that came out, because a number of big analyst firms flipped bullish. Now some of the analysts still kept our bearish. There's some like I don't understand these guys that have it at like $5. I don't understand how they could be there, but we had some street high $30 shy. We had a number of big analysts raise it to 25, 27, and that offering got gobbled up in like a minute. The offering was done like 24 hours later. And basically what happened, Shai, institutions came in. So all those people that saw it respond and go to like 25, 26, and then they saw the offering and they saw it pull back 6%, they all got out. So they waited all that time, gave up the gains, freaked out, sold their position. And then the next day, now you've got the company, it's got more liquidity. It can do, I even tweeted something like maybe it's a Bitcoin treasury. I mean, they could even do that. But the bottom line is they got themselves into an amazingly good position here. I am so proud of the company. I'm so proud to be long this company. And I also own Robinhood. So, just know that like, this is not a weird phenomenon for me. But Chad, what do you think? I mean, I was kind of on the right track there. Like,
you were
like, retail got shook. They got shook. They couldn't wait 24 hours to figure out what they were doing with this offering. And institutions came in at $21, which is the new floor. So they all got in. They went short to long, got in, and they're probably going to do great.
No, I mean, just look at this. Look at this right here.
That's called a beautiful chart, isn't it?
This is a non-lending business part of SoFi. This is crazy growth. This is what I mean by Noto being the operational ninja that he is. Everyone knew them as a student loan company for years. That's what their whole spiel was. And that's why during the previous president's administration, they got penalized significantly because student loans got paused. That was their bread and butter. Not anymore. This is like not just casual growth. This is compounding every quarter. Look at this CAGR, 145% the past 4 years. That's wild. That is so wild. This is going to be $1 billion probably in next 2 years. That's substantial. So I think that it's really important to know why SoFi is catching a bid. And I think it's because they're creating this like neobank ecosystem that's very different than what Robinhood's is. But it doesn't mean they should be penalized because they're tackling a different part of the fintech equation. And I think that this is a name, technically speaking, it's breaking out. Fundamentally speaking, clearly it's on fire. I'm not even showing the membership growth. So I think that this is something where it's going to continue the momentum. It's what's the market cap for this name? I don't even know. It's pretty.
No, it's still a sub 20.
Yeah, it's still
right now. Like it's sorry, it's 25 at 21.34. So yeah, it broke through after it hit 20, but I mean it's been floundering in the 15 range for a long time, 10 to 15. So
well, that's the issue with me is like I don't know how to value them though. So that's why I'm just a part. I haven't participated, but doesn't mean I'm bearish. It's not my lane. It really isn't. But we can move on to the next.
It's okay, but I feel better just having gotten that off my chest. Talked about my tearful drive to the gym at like 6 a.m. when the print came across and I saw the movement. You got to know how like broken I was after like 6 or 7 pretty good earnings reports where it just absolutely faded so hard. And that day actually ended up being hard though, because it faded all day. Like it crushed. And then that was the institutions knew something. Somebody knew about that shelf. Somebody knew about that shelf. And like,
they always do.
Somebody always knows something. Somebody knew. So what was happening was the institutions were getting long, but they were flipping positions and they were selling and taking the gains on the short. They were shorting the crap out of it all day, bringing it down, and then getting ready to buy back in at $20.85 or whatever that offering came in at. So Great play to you, Wall Street. But I'm up like 200% in a month, so I'm cool too.
I mean, you added a lot under $10, under $5 actually. So
I
let's
hit
talk
it.
about the other.
Yeah, go ahead.
Let's talk about the other fintech name that got reported, which was Robinhood. So I think Robinhood's price action is probably confusing a lot of people on why it's, I don't know, was it down 8 to 10% after their prints past couple of days? Listen, their Q2 print was incredible. Like when you look at them, look at it, it's $1 billion in revenue. Top line's 45% year-over-year growth. I think they're growing their EBITDA 80%. This is and also they had a 56% or 58% margin profile. All three of these metrics is incredibly rare in fintech. But I think it's really important to know that I just don't think the market's fully getting how powerful the model that Robinhood's building is. Like they have 27 million customers today. They're growing their ARPU, average revenue per user, and I think they're clearly not
No
just.
poo will ever be our poo.
I think it's really important to realize that it's $100 billion company now. So I think that's knowing that they're going to continue launching multiple products throughout the next couple of years, their cost per acquisition of their customers will diminish over time because they have 27 million customers right now. They launch a new product 3 months from now. That cost to acquire those customers is going to get lower and lower because they have everyone in that ecosystem already. That's what the flywheel is called. This is the fintech flywheel that everyone talks about. And it's clearly accelerating because when you look at their crypto revenue, for example, it's still, that's like the one heartburn I had where their crypto revenue declined for the second straight quarter. And that was even with the total segment revenue it seemed up, but that was thanks to Bitstamp. But really, if you take that out, it was declining back-to-back quarters. And there was a fear where you saw the crypto slowdown happen for Robinhood 3 or 4 years ago. And that was like an early indicator of maybe volumes across retail is going to start to crack. But I don't know. I just think that is premature. I think that crypto still hasn't had that blow off top before it hits a bear market. So that's part A. Part B of like, I didn't love it was their net interest income is now like, I think 40% of their revenue mix. And
so can I just quickly say, because
yeah,
you're on a good roll here, but this is a great example of what I meant about like not all companies in this boom are created equal. By the way, I'm long Robinhood, have a sizable position. I'm also kind of expecting it to maybe retest like 80, $90 at some point. Like in a pullback, it could go back to 60, 70.
Yep.
By the way, it will be eventually 150 or 200. But like you just have to look at a name like this and go, it's had an incredible run. It is valuated, if not perfectly, maybe high. It's maybe slightly high on valuation right now. People obviously buy the future. I don't own it over Tesla right now. Just saying, I'd actually own Robinhood. I think it's got a more robust cash generating machine than Tesla. It may not have as much alpha long run, but I'm just saying, like, this is the point. Like Nvidia and Robinhood are not the same. And so, like, while yes, all of them can move, like there are companies right now that have had incredible runs that are incredible companies that still could have a really sizable pullback.
No, I agree. And I think that the reason like Nvidia probably won't have a similar pullback to Robinhood is, guys, we just saw the big four customers, how much higher their CapEx spend is going to be. Azure was substantial beat on CapEx, or Microsoft, not just Azure. But every single big four, they continue beating what the estimates are. Guess who's railing it in? It's going to be NVIDIA. And I think that AI infra is just truly getting started. Like it's going to increase and increase. And the craziest stat for me was 85% of IT spend is still on-prem. So when you're seeing these cloud numbers from these big cloud service providers, we're still so early. Only 15% of IT spend is being optimized right now on cloud, and they're still making this much money. So I think that once AI continues scaling up, and I think that once even quantum, like Microsoft made that commentary on quantum is going to be the next accelerator for cloud spend. Once that has this ChatGPT moment as well, like I do think these like Googles, Amazons, and Microsofts, they're going to have plenty of runway in their cloud business, and it's going to be like a 25% grower for a long, long time. And I think you're seeing Azure grow 32%. You're seeing, 39%. You're seeing Google Cloud 32%. AWS is at 17%. And that's why I kind of want to talk to you about that, Daniel,
Yeah.
where Amazon, AWS, I think they're getting penalized today purely on AWS numbers. That's where the whole market cares about. And they came in a smaller delta beat than what the Azure and Google Cloud did. But the interesting commentary was it wasn't demand driven, the slight beat. It was due to energy constraint issues and compute constraint issues because their backlog is at 25%.
Yeah.
So, why do you think that is? And what causes disconnect on not being able to fulfill the demand and causing a lighter AWS growth, but the backlog is screaming, wow, wow, we have so much demand for AWS?
Well, remember early on, AWS took a little bit of a different path. I remember being at a reInvent and their CEO, not Matt Garman of AWS, but the CEO, Adam Selipsky, which I think this is ultimately probably why he got fired, really leaned hard into the owned infrastructure. I don't think the thesis was wrong, but with Trainium. And I remember at the event, like he had a slide and he did the whole, here's our NVIDIA partnership. And this was when Jensen was doing all his walk-ons at every event to do the, and then literally right after Jensen got off stage, he flashes about, well, but we also have Trainium and our own network. And I think AWS underestimated demand a little bit and underbought NVIDIA. And so these are those decisions that get made and they aren't always easily recoverable because really through this whole AI pivot, the AI clouds have sort of been more leaning in the direction of Google and Microsoft. And of course, some of these neo clouds and AWS has felt a little bit like, we make the comment about what's old is blue, like a little bit of the IBM or, the Oracle, which has changed its fortune of this era. And so, you tweeted that maybe in a year, AWS could get surpassed. I think it's closer to 4. But the fact that it could even be passed by any of these other clouds is so hard to believe, given the size scale that AWS had created during the CPU era. So then, if it's not just about NVIDIA, it's also about having the required energy to support growth and scale. And that's a little bit harder too, to get access. We're building out these gigawatt data centers and these, huge data centers. There's a lot of capacity that needs to be expanded. And clearly AWS needs to expand zones, expand capacity, and have more available, super CapEx intensive. And by the way, Shai, I don't remember because there were so many different raises, but like, did AWS raise its CapEx number? Did it actually?
It did. Very little though. Yeah.
Okay, but not much. But like, that's another thing. I actually think, ironically, people have been sort of like getting indigestion about the amount of CapEx. But I think like with what Meta's done and what Microsoft has done based on their spend and how they've gotten growth and earnings out of it, I actually think people are starting to get like greedy. Like, I want to hear you raise CapEx. I want to hear a bigger CapEx number out of you. And I think, while the overall Amazon business has had some margin contraction and has some risk there, I think they're going to have to lean in. I think they have to spend more.
Well, I think the margin erosion isn't due to weakness, though. That's what's really important. I think it's just due to almost a catch-up CapEx for them. Like, they're going to have to go really hard in investing in the custom silicon, the new regions, AI workloads. Like, we're talking Trainium 2, we're talking cloud, we're talking Deep Fleet, I think is the one. They're all going to be they're on AWS, and all of that is like kind of laying down the groundwork for a higher margin, more defensible cloud stack in the long run. And that's going to look very different from the commodity compute of 5 years ago. So I think that people are using old frameworks to value AWS on that. Are they losing market share? Is Azure and Google Cloud the only serious AI players? I just think that it was, like you mentioned, like, I'll be a little more aggressive than you. I think they fumbled the ball very aggressively on getting the compute net, all the AI tools necessary to meet the demand, because they're losing out on a couple $1 billion, to be honest, on this misstep. And they should be growing at 20% when they're growing at 17% because they just have a compute and energy constraint issue. And that's crazy to see, especially when AI has been the main show for a couple of years.
By the way, our live audience is saying this has got to go on YouTube. Just a quick reminder, said this earlier, the Futurum Equities pod is now on all the pod networks, and this will also be up on YouTube. So I know not everybody's on X. X is still my favorite. Am I allowed to say that? Yeah, I absolutely love X. I know you're kind of like a TikTok guy, but like, I am an X guy. I love X. No, that's a great analysis on Amazon. I think the only ads I'd have on Amazon is we hyper focused on AWS because that's probably deserves the most attention. Ads business, a total juggernaut, amazing. I think they're the third biggest in ads now. And by the way, this company still has so much vertical integration and scale opportunity, like physical AI and robotics, like how much cost and efficiency and earnings they can drive with what they're doing. I know that the human part of that is like, ooh, that's a little disconcerting about people because it's a employer of like 1 million plus people. But they're just getting started with robotics and autonomy.
Let's talk about that too, because I think a lot of people are ignoring that their North American margins jumped from 6 to 8% due to robotics and automation. And their international margins, I think, are actually at 4%. You guys are probably thinking like this is just such small potatoes and margins when you have AWS having 32% operating margins. You guys have no idea how for years their retail business was break even. AWS was feeding all their profitability. Yeah. If there's a margin expansion opportunity on the retail business, which is probably the greatest mode of all the markets, Amazon and Amazon Prime, their logistics network, that's underappreciated by the market right now, especially when you're seeing that jump from 6 to 8%, from 0 to 4%. If that continues to maybe the low teens, that's a massive earnings expansion story. And that's why they had a very big earnings beat just yesterday. But the market just cares about AWS. All they care about is AI. But physical AI is going to become a massive lever for Amazon to pull because of that retail moat that they have is going to enable them to capitalize on it. And that's only going to continue. It's not just going to be a one-off margin expansion. It's going to, as volume of their business goes up and up, the cost of it goes lower and lower due to physical AI. That's margin expansion. That combined once they get enough AI tools to fulfill the demand on the compute side for AWS, it's going to be kind of a perfect storm on them growing the top line at a healthy amount, bottom line expansion. And I think this was one of those opportunities where I bought today just because if you look at PG ratios, I don't know how much you use these kind of ratios, Daniel, but it's how you factor how quickly a company's growing their earnings based on their multiple. The Mag 7 right now using 2026, they're trading at around 2.8. Amazon's trading at 2.2. I don't think Amazon deserves a 25 to 30% discount compared to its peers. That was before yesterday's earnings. Now it's probably a little greater, actually. So that's why I think it deserves like a 25% re-rate just to be aligned with the peers. And that's why I added today, even though I still don't think it's undervalued or cheap. It's probably fairly valued compared to the peers being overvalued a little. I added 10% to my position, but I think this is the one where the market's seeing missing the forest and the trees. But
let's let it ride. I think we covered it pretty well, but yeah, I agree.
Let's talk Apple then, because I know Apple is one that I think the market's completely misreading what their earnings report is. I'm actually quite bearish on it, but I want to hear your take before I go full bear.
Yeah, I'm a pretty well. It's my disdain for Apple is pretty well documented. They got more researchers poached, but here's kind of like a tale of two things. They're like, record iPhone numbers, but I'm like, is this like being really good at selling Jack Daniels at this point? Like, I don't know that this says anything about them being a great tech company. Just they have a product that people still like. What they do have is incredible loyalty, and they do have a incredible install base to tap into if they can figure out how to monetize AI. The quarter was actually pretty good. And what I'm saying is like, look, I was happy with that because frankly, I don't want any of these companies to do bad because it's going to just hurt the whole market. But I think you helped me craft a tweet about this. Like, it was all about the showmanship, and Tim Cook is not a showman. He is not telling a story. He probably said the most bullish things about AI the company has said in a long time. Like, we actually are accretive. We're actually acquisitive here. We're acquisitive, not accretive. Here about potentially acquiring something. And I said the Perplexity trade is back on, or is it Mistral or whatever it is. But like, I mean, the numbers were good, but I'm just so bored. Is it even a Mag 7 company anymore? Are they just another devices company? Because look at how like HP is treated and like companies that are like just hardware companies. Apple's just a hardware company with a credit card and some movies on demand. I mean, I don't know, but don't love the company, don't love the story, but I actually still think a good AI narrative or a good AI acquisition could send this thing parabolic because of the pullback.
I think this is complete. It's yesterday's print was a masterclass in optimization. That's what Apple's earnings were. You saw a very strong quarter on the surface. You saw the revenue beat, the iPhone beat, like you mentioned, EPS beat, services at an all-time high, but it's just due to discounts from China that caused the iPhone beats. It was a very aggressive promotion that it did. It's also a pull forward in demand. Like everyone in the US was anticipating a tariffs coming to play. They wanted to buy iPhones before that came to light. So I think that it wasn't enough for me to justify like them being green on trading above 30 times earnings, because it really was just a weird, wonky like discounts, buybacks, and install base leverage. Like right now, like they're claiming that iPhone 16 is still going to be the most personal AI experience Apple's ever made. But like, come on, it's powered by an open source model dressed in Apple's UI polish. Like there's no proprietary LLM, which is why there's so much a lot of rumors on Perplexity getting acquired. That's going to help put a band-aid on that part of the equation, but they still have no real compute innovation beyond the Apple Silicon already offer. Like it really is just a luxury front end built on someone else's AI backend, and that AI backend is what provides longevity in any major player to be a winner in this new digital economy. So I think that's like, I think it's just totally misleading. Their earnings report, I think it looks strong on paper. It really wasn't anything that would change the narrative on Apple in the long run. And it's really difficult for me to think that Apple's going to re-energize any of their tiers. It's more like people pay for Apple because something that they buy broke. And that's like not the kind of investment you want to make for me as like once we're going through this AI super cycle. Do you really want to use your capital to buy in a company that really just is staying in their comfort circle on that 2.4 billion device moat and just raking it in on cash where they're not really innovating yet? I feel confident they're eventually going to. There's no reason they shouldn't be the ambient AI assistance winner. And the easiest lever for them to pull in the hardware space is robots. Like that's a no-brainer. Once Optimus scales, or once these robotic theme scales, and once it becomes like $25,000-$30,000 to have your own robot in your house, I think Apple will substantially benefit from that. But until then, it's just like, I think that's actually, it was kind of a weak quarter, even though like, what is it green today? I don't even know what they are today.
No, it was down. It was down. Here, share that real quick. This was my take on Apple earnings. I just flashed something. Can you pop it in to share?
Let me see.
See a little thing down there. I think you can pick it as another screen.
Yeah,
I created this little picture. That super famous meme of the guy looking back and whistling at the girl while his girlfriend looks at him. It's the Apple people. This is right into earnings, staring back at all the Meta investors. I thought this was really funny because this is like, this is what it is right now to be an Apple investor. It's like for a long time it was the only way, but right now it's got to be painful to see all these other companies running. And what is Apple going to do? Buy more shares? What's its options at this point? I mean, that's the only thing. That's the only thing they're doing. 600+ billion in buybacks. There has to be something more here.
Well,
it's going to be zero.
First off, here's what's wrong with Apple. They spent $23 billion in buybacks last quarter, $9 billion in R&D. What are you doing? That is not what you're supposed to be.
That amount of buybacks could have bought Perplexity. What they bought back in shares probably could have gotten that deal done. And again, it does not solve all their problems, but Jesus, the intent, it's just like some sort of intent that you're not going to just miss this whole wave. I'm still not entirely sure in 5 years the phone is our primary device. I do not know for sure. I would not bet any significant amount of my wealth on the fact that the phone is still the main device we're using in 5 years.
I second that. I think
my point though is if they miss this, that's it. That's where the end is. The end is if they miss that wave.
No, I think my grandkids are going to be like, you had to use your fingers to scroll to use a communication device. That's really crazy. I think it's going to be very analog. But yeah, that's enough about Apple. I think we need to talk about Palo Alto. This is
This is you're like, I like them, but I mean, you love this. Where are they on our Cyber 7?
they're number 2. They're numero dos.
Three. They're in the top
No,
three.
3. Yeah, Mike. I always forget about Microsoft.
You always stick CrowdStrike ahead. I don't know.
Do you know?
Does
Here's why. No, here's why I always stick CrowdStrike ahead. CrowdStrike does not have to acquire their way to get the latest and greatest. They've proven the ability to organically create these modules on what the next bottleneck is going to be in cybersecurity, where they don't have to spend $25 billion to get identity. Like, CyberArk is an incredible company. I think it's going to be a beneficiary for Palo Alto, but I don't think people like the price tag. This is what 10x the previous record on acquisition of Palo Alto. So like it's definitely really out there. For me, I think it does somewhat scream what the issue's been on Salesforce the past 10 years. They've had to acquire BI tools to sell the platformization narrative. And you saw in Salesforce, they've continued to do so, and that comes at a cost of dilution. I think there's some fear that Palo Alto might do that. However, I do think that it's really important to remove that part of the equation on why CyberArk and Palo Alto makes so much sense, because we always at Futurum Equities, for example, we talk about where the world's heading. We're very minimal about where the world's been. We're not very fact communicators. We're about where the puck's heading. And I think right now, this Palo Alto bet on CyberArk was a bet on where the direction of enterprise is heading. A future where identities aren't going to be humans, Daniel or myself logging in with passwords, but it's going to be a fleet of AI agents, autonomous systems, making decisions, executing tasks on the behalf of the business. We're already seeing signs of that right now on early agentic AI winners in enterprise, and it's going to only continue. It's where enterprises are going. So now, the question becomes, who's controlling that control? Who's going to control that control plane? Who's going to govern the privileges of these AI agents, autonomous systems, verifying these LLM outputs before they trigger like really important transactional and access sensitive systems? That's what CyberArk does. And that's essentially why Palo Alto valued them so highly and brought them in. Yes, price tag, $25 billion is a lot for, I'd say, an unsexy part of cybersecurity, but I think it tells a lot of people more about how early we still are in the shift, where it's much more than fundamentals. It's going to become where cybersecurity isn't just going to be optimizing endpoints, perimeter defense. It's going to be identity first, agent secured architecture of tomorrow's enterprise AI. And I do think that this highlights where the puck's heading. Price tag is and there's going to be some dilution in the near term, but like it's down 20% in the past week. That's excessive in my opinion.
That's a beatdown though, because you obviously have the dilution and now you have that big pullback, and you basically lost more in market cap than the entire acquisition in terms of the deal.
Yeah.
But also people that like the name and maybe we're waiting for that right opportunity. This might be one of those like where this short-term sting, because let's talk about kind of more thematically, cyber is super fragmented. The biggest company is Microsoft in this area. They're our number one on our Futurum Equities Cyber 7. But they're, in terms of a pure play end-to-end platform, there is no company that's doing it better than Palo Alto Networks. Spent time with Nikesh Arora, their CEO, and he was very open about their acquisitive nature, the fact that they were going to grow that way. And so this is their approach. Last week it was SentinelOne. This week it's CyberArk. Maybe SentinelOne's still coming. I mean, who knows? I mean, that would be an incredible amount of acquisition in a short period of time. But right now, if you look at why we like cyber as a category so much, it's because as an adjacency to AI, there is nothing that's going to see scale more rapidly besides AI itself than the need to create a defense for all of the things that AI can do.
Mm-hmm.
Palo Alto, this has to put them at number 2 for us, for sure. There's no way these two companies combined, number 3 and number 6 together, doesn't kind of get a bump, barring failed execution.
Well, that's the beauty of these lists, because a lot of people confuse like my personal opinion about a company versus what the Futurum list is. This is a great example where you guys know I love me some cyber CrowdStrike, but these lists we create these lists based on the Aerometer algorithmic score based on actual access to data that Futurum has behind the scenes. This combined with our great team, we put together this list. It's not just me, so it's a great example of why Palo Alto might leapfrog CrowdStrike on that list. We're having an open discussion about that probably in the future, but it's not going to be because I say so or Daniel says so. There's a team and access data
Data,
environment.
we'll let the data talk. I mean, our
Yeah.
opinion is a one, small component to the total scoring. So
Let's talk Qualcomm, because I do think Qualcomm is probably one of the most misunderstood companies out there, especially in the robotics theme. I want to hear your input about that.
yeah, so there's a video out there of me on Bloomberg talking about it, and I did have a chance to speak to both Akash, their CFO, and Cristiano Amon on earnings day. This is a company that just kind of executes quarter to quarter and continues to just get beaten up. And I think this is two things. I think Cristiano's needs his showman moment. And the showman moment is, look, this is a company that's kind of in between two worlds. The existing world of handsets and licensing, which, by the way, has been a boondoggle for a long, long time. Qualcomm, kind of like, ARM, and yes, there's a feud there, but is in everything. Basically, every device, including most Apple iPhones, at least for the next year, will have at least some Qualcomm technology in them. And of course, they've greatly diversified their business. So it used to really just be all about handsets, but now they're in XR and they're in smart watches. They're in automotive. They've built a $45+ billion pipeline for automotive, for their ADAS and for their infotainment systems. They're in IoT. They've built this big platform around IoT. They're in ARM-based PCs, Qualcomm PCs, and they get almost no credit for all the diversifying that the business has done. There's been great growth in those diversified areas. They've had good growth, 15% barring, sans Apple. So when you take Apple out of consideration, the overall growth is good. And they continue to deliver on earnings, but they're not making these big beats and big raises. Their guides aren't like, wow, holy crap, they're going to blow everything out. And I think the big moment for me, though, Shai, and here's my take. The robotic company of the future, physical AI and robotics, is Qualcomm's future. A mobile SoC is a super efficient, low-powered system on chip that can basically do, it's got the GPU, it's got the VPU, it's got the networking in it, it's got low power consumption, it's got all the compute horsepower needed to run your phone. Well, there's a lot of value in how that might work in robotics. Then you look at ADAS and XR, you look at vision and ADAS, and you look at how that could, and then you look at the fact that they can provide their technology at a low cost to a lot of these like Chinese companies making robots. And now it's not just handsets anymore. Now they are literally the engine of robotics. And so while Optimus may win that top end, $30,000 robots have some limitation. The ability to develop lots of volume robots in the $2,000, $5,000 type range, humanoid and non-humanoid. Holy crap, that's a real opportunity. So I think the showman moment is all about kind of, yeah, this is our business today, but right now you almost got to be a little more Elon Musk. Like in 5 years, this is what our business is going to look like. And people need to feel that. They need to feel like I'm not investing in the handset company that licenses their technology to everybody. I'm investing in the company that's going to win a real part of the market share. One last thing I'll say is they have a data center entry in some type of data center CPU and some type of AI. Some strength in the messaging there. I know it's a little early, but I think that would go a long way as well.
No, I think you nailed it. I will say, if it wasn't for you this week, like I'm starting to look into Qualcomm more because they're undervalued, guys. Like this is 15 times earnings. Like this is not a stock that has a robotic premium assigned to it. And it really, the more I was looking into them, like, it feels like a picks and shovels play on physical AI. And that's something that is really enticing at 15 times earnings. But I know we're about to wrap up. I do want to go over one company that reported this earnings.
We got time.
You got time?
Let's finish up. Yeah, let's go through
All
everything that we got through.
I want to go over ARM Holdings because I think ARM is having a similar Amazon moment where the market's treating what they're reporting as missing what's really actually happening. And a lot of people don't realize ARM has 50% of the data centers are built on ARM. Like you're thinking Microsoft, NVIDIA, all these big players, they're putting their future around ARM's blueprints. So I want to pass it to you because I know you talk with Renee, you have some access, and I think that they're slowly changing the narrative from a blueprint of the new digital economy to now an actual player in data centers, and that's a much higher TAM.
Well, it's about 50% of data center CPU now. I mean,
Yeah, crazy.
and this isn't even including the next generation of NVIDIA that's going to be all based on ARM. Like so much, like, we remember Grace, the Grace and
Yeah.
Grace Blackwell, So that's a really big deal. And the company's been optimizing itself for higher margins. It's been diversifying more towards custom and subsystems as opposed to as many of its architectural licenses where it's like royalty. It's super high volume, billions of chips, but very, very small revenue. So you're talking about a company that's about $4 billion of revenue that has traded well over 150 billion in market cap. So it's priced in, I mean, we rank it very high on Futurum Equities, the AI 15 list, because it's got so much critical adjacency to all of the massive AI deployments that are out there. Now, having said that, it hasn't had like a real pure play AI story. It's not an accelerator. They're not making GPUs. They're in that compute, the CPU for AI. They're basically is kind of like the narrative. It sounds like it might change. And yes, I have spoken to Renee, but this is from public commentary. He really did indicate that there is a chance that the company will get into solutions for AI. What does that mean? I mean, it literally means they may make chips for AI, accelerators. That brings the company into this interesting juxtaposition, Shai, because like on one end, here's a new market, tons of TAM, tons of growth. ARM is trusted, deeply entrenched. Some people will go, oh, everyone's going to go to RISC-V. It's over. They're going to get pissed. The customers are all going to walk. It's not that easy. First of all, it's pretty sticky. ARM is trusted. ARM works well. These verified designs are trusted in the market. But having said that, it does enter new competition. Competing, whether has been with companies like Qualcomm, but it could be Broadcom, could be Marvell, it could be, dare I say it, NVIDIA. And so it does take a level of boldness. But I think if you're Renee Haas and you're looking at the company and going, where do we get TAM? Where do we get growth? There has to be a play now. So I back it. I do think there's some risk, but I think the company can execute it. And I'm eager to see how it goes because, like I said, it could be as far as making their chips, could be as far as offering like more IP for AI specific chips. But they've got to get into that TAM. Nobody wants to just be in the CPU space right now. That's not lucrative enough, not enough growth.
I mean, listen, the AI TAM is freaking massive. Why settle for a niche? That's essentially what ARM is doing. Like, there's a bigger pie they want to conquer. Like, why they have an incredible slice of that pie, that 50% of the data center CPUs, but the appetite's there because nobody really knows how much of that total pie there is. And you're clearly seeing there's so much money being spent right now on AI that having an accelerator or an offering like that is going to be a no-brainer in my opinion, especially when they kind of have access to a lot of the nitty-gritty as the picks and shovels play already. So like, why not create your own offering? So that's ARM Holding. I'm trying to think about what other name that we went over a lot of names this week's episode, but we got
you
a
want
lot
to just
more.
hit on kind of the macro a little bit just for a minute before we let
Yeah.
everything go, because like we've had a lot of news. Like President Trump dumped a lot of tariff news this week. Jobs data came back very soft and interesting. And we started the show kind of talking about, is there a pullback in the future? But like, how good is the economy and how much, what I'll say about tariffs is like, I still find it really interesting. I wonder how much of it's algorithmic and how much it's really selling when these tariff news comes out and you see these dips, because I feel like we've just swallowed that stuff and moved on like pretty consistently. But that jobs data was rotten. I mean,
Well, I think
we're going to need to cut rates. Like, I think rate cuts are coming for sure.
Well, I think it's also the uncomfortable gray area. Is bad news good for the markets, or is bad news bad news? So like today's perfect example. Clearly the job market is job reports fudgery. It's the revisions are so aggressively on the downside that you just can't trust the numbers anymore.
So long too.
They're so long. Like 3 months ago, we were getting revisions on what May numbers. It's crazy. But I think that Dano has a lot of exposure in the space. I have exposure in the space. Like the jobs are not as fruitful as the reports indicate. So it's actually a lot worse than what you see on paper. And I think that the odds of the Fed cutting rates in September skyrocketed off of this morning's print. It went from like 30% to 65 or 70%. So I thought maybe the market would catch a bid because of that. It's been doing that past couple months. Anytime there's bad news, rate cuts are going to happen. It's caught a bit. So today is somewhat new behavior where that was not the case. It could be a combination of seasonality weakness now is in play on top of the bad news, or there is a real fear that Powell missed the boat on cutting rates, where this is going to be like a couple years ago where he was too late to like raise the rates. He's might be a little too late to cut the rates, and inflation is not a big concern, I think, from Daniel or I, because we understand that AI is going to be a massive deflationary event. The productivity boom is going to cause a GDP bump. But what isn't going to help is a recession. Recessions are tricky. It takes a lot more time to get out of than inflation in this environment we're in right now. That's my opinion. I don't know about Daniel's opinion on that.
The one thing I would add is I just think the macroeconomic approach, the policy being set forward not by the Fed but by the White House is in an unfortunate crossroads, is an unfortunate impasse right now, because Secretary Bessent and the Trump administration are totally leaning into, we're going to grow faster than we increase inflation and spend. Basically, they've conceded that there is no way that we can actually meaningfully get back to any sort of fiscal discipline. Suspending will continue. Okay. Interest rates being high is bad when you're going to keep spending like we're spending, because we're running up debt and we're servicing that debt. So that's at the macro level. But then if you look at how that trickles through the economy, right? You have so many people that 5 and 6 and 4 years ago that bought homes and have 2% interest rates. And these people might want to upgrade their home. But the problem is with inflation, prices on homes are still high. But rates are high too. So if we don't bring rates down, people are like, well, what if the prices go up? But it's like the average person can deal with the debt. They can't, they don't have the cash, meaning they can't buy a house because it's a little cheaper for cash. They need to be able to finance. And when you're talking about 7 or 8% mortgages, you're talking about 10% car payments with still very expensive things. And then you talk about businesses borrowing, you talk about consumer credit, people that are taking trips and putting on cards at 19, like it is going to be unfathomable. So bringing down rates to stimulate the economy, to get people moving, to get building projects and construction going, and to get businesses borrowing money to invest in their companies. Nobody wants to take debt at 10%, 8%, 12%. And certainly most people don't want to move if they have a 2 or 3% loan and move into a 7 or 8% loan. Like, what do you get, half the house for twice the money? Nobody wants to do that. So it's slowing down commerce. It's slowing down the engine of the economy. And this needs to be thought about, because it hurts the debt service at the government level and it hurts the debt service in the average home.
No, we should have been 50 basis points lower already. I think this is kind of getting to a point where we're missing the boat. Like I'm looking for a house. I'm a first-time house buyer. I know my friends, they've bought houses a couple years ago. They won't leave because of the interest rate. Like they want an upgrade. They want to move on from the 3-bedroom house to a 4 or 5-bedroom house because they have kids, multiple kids. It's not enticing enough for them, because like Daniel said, the housing prices isn't that much lower than it was a couple years ago. If that, it's maybe 5%, barely. Interest rate expense, 3x. It's 3x every month, and that's just a tough pill to swallow, because that expense is going out the door. It's not going towards equity. It's a waste of money. A lot of the mentality. So I think that, I don't know. I hope we get 50 basis cuts sometime next quarter. I think this.
By the way, I loved Waller and going after him though. Waller,
Waller's going to be he's going to be the new Fed chair. I think
Waller just literally positioned himself, and I love that you said that, because I basically said Waller just put a big middle finger up to Jerome Powell in public, and obviously we had the dissents this time, and that's when you're getting closer to a pivot, because it's been unanimous. Now you're getting the dissenters. I just think it's look, whether you're President Trump or Jerome Powell, I really hope Fed Chair Jerome Powell is not playing politics. I really hope that just deep down he believes. It's embarrassing to me, and this is probably something that's a little probably outside of the script of the show, but I think our audience would appreciate this. Like, you think with AI and data and predictive analytics and all the things that are out there that we can't get a better forward-looking analysis, and we're still using data-dependent things on 3 and 6 month old data to make the decision on whether inflation is there or whether tariffs might have a risk. Like, I know I modeled it, but like all the models have been wrong. Like, can we just feed the LLMs and try it that way?
No, I mean, the jobs data is based on phone surveys. Think about that. That's crazy to me. That's why there's so many revisions. I think there's ways to innovate. I was hoping that maybe Elon's Doge program would push the needle on that. Or maybe Palantir's Foundry will just do it for everyone eventually. We'll see about that. But we're past the hour. I do think that this was an incredible. Hope you guys enjoyed it. I know this is record
There's no
attendance.
rules. There's no rules. You know,
No rules.
Our friends at All In sometimes go for like 3 days. You know, those guys. And
no, it's exciting. But I do before we do hop off, I do want to go over what's earnings next week because we're gonna have our Friday episode next week. We got plenty for me specifically. We got Palantir on Monday. We got Hims and Her on Monday. We got Mercado Libre Monday. Axon on Monday. Navitas. You guys know that's my favorite moonshot play. Tuesday we got AMD. We got Supermicro. We got Arista. We got Stereo Labs. On Wednesday we got IonQ. We got AppLove. We got Uber, Shopify, Novo Nordisk, which is just freaking bleeding. We got DraftKings. We got Joby on Wednesday. Thursday, we got Celsius, D-Wave, Trade Desk, Rocket Lab, Square or Block, Atlassian. And then Friday, we got Tempest AI. So it is going to be a jam-packed week of earnings. We're going to have a lot to uncover on next Friday's episode. But this is going to be, if you missed today, because I know we're doing it in the middle of a 9 to 5 schedule for a lot of people who are working, you can tune in at all the platforms, Spotify, Apple, YouTube, etc., to get this recap of this great episode. I think so. I always learn from you, Dana, whenever we talk. Like, I feel like I'm a participant and also a listener, so this is awesome for me. Any final words before we hop off?
I just appreciate the opportunity for this audience to build the relationship with you all. Make sure you check out the new Spotify and Apple. I'm going to do it the 3rd time, but I got to remember that not everybody sits for the whole hour. So if you did make it all to the end, thank you. Need those subscribes, want those subscribes. We love you being in our community. We'll keep dropping it here live for all those people on X that love to do it live. I saw tons of engagement, tons of comments. Thank you all so much for that. But take us on the walk. Take us to the gym with you. We're here for you. And by the way, send all your criticisms to Shy. Like, if you don't like something, send it to Shy. We'll get this right. And check out all the other shows. Investing with the Boys is back.
Yeah.
You got that one back. Of course, you got the Daily Rip. So you can get a lot of dosage of Shy and a little bit of
Wait, Dana, where can everyone get all that information on one consolidated platform? Where can they get that?
Futurumgroup.com.
Futurumequities.com.
Oh, yeah. Equities.com and Future. I got too many companies, Shy. You got to do this for me.
You got too many. Yeah. All right. Go on Futurumequities.com to get a podcast episode for everything that we have in house. And we have a list coming out tomorrow. EU doesn't. Who's going to be the 12 companies going to benefit the most from the US and EU deal that's going to change their demand curve next couple of years? Spoiler alert, it's a lot of AI players, but it's going to be a couple that you actually wouldn't anticipate that have not made it on any of our lists so far. So that's going to be released tomorrow. You can get it on the website and our platform. Thanks for tuning in. See you guys next week.